In this video, we're going to look at LKQ, and this company sells automobile parts. And what I do is I figure out the intrinsic value of a company by running a discounted cash flow model, and then we also look at the financial ratios of the company. So let's get started with the model. The first thing we need is the market cap. That's $7.75 billion, and that's the value of the company according to the stock market. And then we need the stock price, which is what they're trading at, which is $25.50. And I'll put that into the model. Next, we're going to get the free cash flows. And this is the cash that's left over after operating a business minus capital expenditures. And this is how you value a company. You estimate the future free cash flows and discount that dollar amount back to today's values. And that's what I'm going to do in this video today. So I entered last 4 years of free cash flow. Now I'm going to go to the income statement and pull their net income. And net income is a profit and loss. And then I'm going to get the revenue, which is the sales for each year. And that's also on the income statement. So let's take a quick look at the numbers and make sure they look pretty consistent and positive. And they do. Net income and free cash flow look fairly consistent. And looks like sales have been increasing every year, which is great to see. Now let's look at the capital structure of the business so we can figure out what discount rate we need to apply to the future cash flows. So in the income statement, it says they pay $138 million in interest expense. That's the interest they pay on their debt. And now let's go to the balance sheet to find out how much debt they have. We'll go to liabilities section. And then under current liabilities, current debt. That's debt due within 1 year, and that's $326 million. Non-current debt shows the long-term debt. Debt due after 1 year, that's $3.7 billion. So they pay 3.4% interest on their debt. But interest is tax deductible, so let's get their effective tax rate. We'll go back to the income statement for that. And we'll get their income before tax, $791 million. And their income tax, $215 million. So their cost of debt is 2.49%. That's the interest payment minus the effective tax rate. Now let's get their cost of equity, and we'll need the beta for that. And that's the volatility of the stock. And according to Yahoo Finance, the beta is 1.68. So the stock moves about 1.5 times the market. Let's get some more information from the balance sheet. Let's get their current assets. These are assets which can be liquidated into cash within 12 months. Those include cash, accounts receivables, and inventory. So $4.7 billion of current assets. Let's get their current liabilities. These are debts and payables due within 12 months. That's $2.7 billion. And their equity is the value of the company, which is total assets minus total liabilities. That's $5 billion. And the EBIT, we need to go to the income statement for that. That's earnings before interest and taxes, or operating income, which is $980 million. And as you can see, we calculated the weighted average cost of capital because it's a blend of the cost of equity, 15.2%, and the cost of debt, 2.5%. And that comes out to 9.5%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. That's $11.7 billion. We discounted all those numbers by the weighted average cost of capital. And the value of the company in today's dollars is $11.8 billion. And if you divide that by 304 million shares, we get an intrinsic stock price of $39. But they're trading at $26, so they're trading at a 34% discount. So it's a buy according to the model. Let's see what Simply Wall Street says the company's worth. They say it's $39 even, which is really close to what I'm saying. So apparently on this particular company, our models are in sync. Let's look at the historical stock price over the past few years. So it looks like it touched around $40 maybe 2-3 years ago. It's been trading in a fairly tight range between 20 and 35 for a while now. Let's look at their financial ratios to get more information on the business. So they have a pretty good PE, 14.3. I like to see under 15 on a stock. That's price to stock over earnings per share. Really good price to sales ratio, 0.6. That's price to stock over sales per share. That means investors are willing to pay 60 cents for $1 of sales. So getting good value in that category. Also a good price to book, 1.5. That's price to stock over book value per share. Great current ratio. They can cover their current liabilities twice. ROE of 11%, a little on the lower side, so they're not providing the greatest value to the equity holders. That's income over equity. They could easily cover their interest payment. They cover it 7 times, so no risk of default. And they have 45% debt, which is a pretty manageable number. So the company looks pretty good in the ratios and also in the intrinsic value. So let me know what you think in the comments. What do you think about this company? Do you have any opinions? Thanks for watching the video.